On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Unfortunately, gloom seems to be what sells these days. There was a study last year which found that negative words in news headlines increased readership and click through rates, while positive words in the headline actually decreased them. That will be no surprise at all to the journalists among us. If it bleeds, it leads, has been a saying they've said in newsrooms across the world for 100 years after all. But when it comes to the world of economics and investing, negative opinions also seem to get a bit more attention. Nobody gets too excited about the report that's titled Steady as She Goes, Just Stay the Course. But 3 reasons a crash is coming, that'll certainly top the charts and get noticed. So, not only does that negativity get you more attention, but it can also be safer to err on the side of caution. And focusing on the potential risks and things that could go wrong, for some reason, seems to add to someone's credibility. It seems to be human nature that we will trust someone more who is warning us about the what could go wrongs. In contrast, those with a glass half full point of view are often mistaken for being a little bit too relaxed, especially in the world of economics and financial markets. After all, have they really done the work if they haven't unearthed a looming crisis that is coming soon? Analysts, strategists, forecasters, and even some financial advisors often feel like they have more to lose from being too bullish too, and that can mean that the path of pessimism is often the safer one. If they're pessimistic and wrong, people are pleasantly surprised that things turned out better than expected, while they're still grateful they were warned anyway. But if they're optimistic and wrong, people end up out of pocket, and often it's that carefree attitude that gets the blame. There's nothing wrong with being mindful of risks, and let's be honest, at any given time, the list of things to worry about is always a lengthy one. That's the case today. It was the case 5 years ago, 5 years before that, 5 years before that, and I think at any point in the future that will still be true. It's just that what's on that list changes a little bit. Sometimes it's politics, sometimes it's recession risks, sometimes it's high valuations across parts of the market. However, when it comes to investing, being an optimist absolutely pays off. Just look at the US share market. The S&P 500 index, including dividends, has delivered an annual return of 10.8% per annum over the past 30 years, the past 3 decades. So if you had invested $100 30 years ago, back in 1994, and left it alone, haven't touched it, it would have grown more than 20-fold since then, and you'd have well over $2,000. It's not dissimilar for other markets. New Zealand shares have returned 8.5% annually over that 30-year period. The Australian market has delivered 9.1%, including dividends as well. Now, just consider everything that the world has thrown at investors over that 30-year period. We've had the September 11 terrorist attacks, we've had numerous wars in various places, we've had a housing crash in the US, we've had a global pandemic, and we've had 3 major recessions. Now, I can point to 14 times where the US share market has fallen by at least 10% over that period. And of those 14 occasions, during 4 of them, the market actually fell more than 20%. And during 2 of those times, the market fell pretty close to 50%, once in the GFC and once near the turn of the century with the dot-com bubble bursting. So there have been plenty of reasons to sit fearfully on the sidelines and do nothing, just in case one of those potential risks became a reality. In fact, some of those risks did become a reality, but the market still has a flawless track record, the US market that is, of recovering and moving on to bigger and better things. That's why it's trading at all-time highs today, despite all of those things that have happened over that period, and it's given you a return of pretty close to 11% per annum, which is remarkable, really. Having said that, pessimistic investors certainly aren't without options. There are plenty of things you can do with your money and your capital if you are nervous about all the things that could go wrong or the potential ups and downs. Cash in the bank, as an example, hasn't lost a cent at any point over the past 3 decades. No matter what's been happening in the world, it's always been very safe and very stable. However, the return over that 30-year period of 4.9% is fairly subdued. And $100 invested in 1994 wouldn't have grown to the level that you've seen from share markets. It would have only grown fourfold. So it would have grown from $100 to $415. So not only has that anxious, nervous investor spent a lot of time and energy worrying about what might go wrong, but probably won't, they've also found themselves about 80% less wealthy than that more relaxed optimist. There's a great quote from US tech investor Nat Friedman from a few years ago. He said, "Pessimists sound smart, optimists make money." And that's a great quote. He wasn't referring to financial markets, but I still think there's something we can learn from that as investors. There's nothing wrong with being a little bit cynical. In fact, it's a good thing. A healthy dose of skepticism can absolutely keep us on the straight and narrow as investors, but too much of it can hold us back from making progress or from taking opportunities. So, as in life, and particularly when it comes to investing and financial markets, the truth is often in the middle, and you need a little bit of balance. You don't want to be at one extreme or the other. You don't want to be blindly optimistic and think that everything is fantastic, nothing to worry about, but you don't want to be overly negative and pessimistic either. So don't write off the optimists just because you feel that they aren't panicking enough. They might have more common sense than you think, and they might even have a longer term view. Thanks again for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.